Hello everyone. In this video I want to walk you through the general approach that you can take towards estimating a firm's or a project's cost of capital. Now in a previous video I've explained that when debt holders or equity holders are injecting their capital into a project or into a firm, so they're investing in certain assets, well, they are bearing a certain amount of risk. And all else equal, the higher is the risk that they're bearing, the higher is the rate of return that they require on their respective capital. It is also important to note that when debt holders and equity holders are injecting that money into a particular project or firm, they are foregoing the opportunity to earn a certain rate of return on other investments that are out there which are of equal risk, which is why there is an opportunity cost associated with debt and an opportunity cost associated with equity. So we can think of required rate of return on debt as the cost of debt and the required rate of return on equity as the cost of equity as well. Now, a natural question to ask is how do we measure risk? And perhaps more importantly, can we quantify the relationship between risk and the rate of return that debt holders and equity holders require? In other words, can we say that if risk goes up by this much, this is the amount by which the rate of return that debt holders or the rate of return that equity holders will require will go up by? As you can imagine, if we could do that, then we'd be able to measure cost of debt and cost of equity. In other words, we'd be able to estimate our cost of capital. So it turns out that yes, we can measure risk and we can also quantify this relationship between risk and expected rate of return. In finance, when we talk about risk, we don't generally mean volatility of cash flows or volatility or standard deviation of returns, because we recognize that some of the risk of an asset's cash flows can simply be diversified away. Now, in this particular video, I don't want to go into the depth of what is diversifiable risk versus what is non-diversifiable risk. But essentially in finance, we recognize that assets have some risk that can simply be diversified away by investing in a large portfolio of assets. However, some of the risk cannot be diversified away because there are systematic factors out there like interest rates, like GDP growth, like unemployment. Any impact on those affects all assets one way or another, which means that we cannot diversify away that risk by just investing in a large portfolio of assets. So that risk is referred to as an asset's systematic risk. And in finance, we measure that risk with what is known as the beta of an asset. Beta, simply put, is how sensitive an asset's returns are to the returns on a well-diversified portfolio, which in finance we also refer to as the market portfolio. So to answer the question, can we measure risk? Yes, we can measure risk of an asset vis-a-vis its beta, which is how sensitive that asset's returns are to the returns on a well-diversified portfolio, which we also refer to as the market portfolio. And in fact, in finance, we often proxy the market portfolio using a well-diversified portfolio like the S&P 500. As to the second question, which is can we quantify the relationship between risk as it is being measured by beta and the rate of return that equity holders should require? The answer to that question is yes also. In fact, in finance, there is a model called the capital asset pricing model, often abbreviated as CAPM. And that model says yes, the rate of return that equity holders or debt holders or really an investor in any asset, call it I, should require from that asset should be at least equal to the risk-free rate. So even if there is no risk, you should require at least the rate of return that you can generate on a risk-free asset. And then if there is risk as it is measured by the beta of that asset, then you should require some extra return as the beta times the excess return on the market portfolio. So expected return on the market portfolio minus the risk-free rate. This is what we refer to as the expected market risk premium. Again, I don't want to go into the details of where the CAPM comes from in this particular video, but the main point is that CAPM is saying is that the higher is the beta. In other words, the higher is the risk, more specifically the systematic risk of an asset, the higher is the rate of return that we will require. So for our purposes, if we have assets on the left-hand side, we know they're funded with debt, we know they're funded with equity. If we can understand what is the risk that our debt holders are bearing vis-a-vis the beta on the debt, and similarly, if we can understand the risk that our equity holders are bearing vis-a-vis the beta of their equity, so beta B refers to beta debt or the beta on bonds, and beta S refers to beta equity or beta on the stocks, then all we got to do is take those respective betas and plug them into the capital asset pricing model. And if we have some of the other inputs, in other words, if we know what is the risk-free rate, if we know what is the expected return on a well-diversified portfolio or a market portfolio, and how much that is going to be in excess of the risk-free rate, then we can estimate the rate of return that debt holders should require. We can estimate the rate of return that equity holders should require, and this therefore will give us our cost of debt and cost of equity. Now this begs the next question, which is how do we estimate the risk-free rate? How do we estimate debt beta? How do we estimate equity beta? How do we estimate the expected market risk premium? In other words, how do we estimate all these different inputs that go into the capital asset pricing model so we can estimate our cost of debt and our cost of equity and therefore our cost of capital? These are great questions, and this is exactly what we will be talking about in more detail in subsequent videos. But the purpose of this video was to help you appreciate the general approach, which is that at the end of the day, cost of debt and cost of equity are a function of the risk that debt holders and equity holders are bearing, more specifically systematic risk, and to also show you that the way we can quantify the relationship between systematic risk and cost of debt and cost of equity is using the capital asset pricing model. If you found this video useful, click the like button and subscribe to the channel. And feel free to ask any questions using the comment section. Happy learning.